Hello, greetings, and welcome to Dividend Blasters. This is our 31st video. The topic today is more strategic dividend investing, building that dividend snowball each and every month. So when I say more strategic dividend investing, this is really a continuation of a video I did 10 videos ago, a couple months ago, where I shared with you my portfolio allocation among my holdings. And I shared with you the breakout of my dividend income by month. Okay, so I'm going to share with you that again because some things have changed. And you know why do I do this? Because I think that it's important as dividend investors, as we all build our wealth and continue on that roadmap to financial independence, to know where it's going. Okay, when can we expect our dividends? When we retire, at some point we're going to have to live off of our passive income. That's why we do this. In addition to Social Security, if it's still there, we hope, we have our passive income. All right, we have our retirement income from our jobs, our IRAs, our 401ks. Maybe we have taxable brokerage accounts that we continue to build on the side. Okay, maybe we do all those things. It's good to know when that money is going to be paid out each and every month, because at some point we're going to start living off of it. We're going to maybe stop building the snowball, stop dripping, and maybe start taking a distribution here and there. Right? So that's why we do this. So I did this 10 videos ago. I'm going to do it again because some things have changed. I'm going to share with you what has changed and why it has changed. I think it's instructive. And I'm also going to solicit your feedback because I am looking to build additional holdings into my portfolio. So why do we do this? We do this because we want to choose the best dividend investments that are going to build our dividend snowball each and every month. Now, a quick disclaimer. As you know, I am not your financial advisor. The purpose of this video is for financial education. This reflects my own personal opinions, my research, and my experience. I've been an independent investor for more than 30 years. However, please do your own research and consult a financial advisor prior to making any major financial decisions. So, what is different now than was 10 videos ago for me? I've divested some of my holdings. I have divested all of my holdings in REITs. I have divested all of my holdings in covered call ETFs. I have divested all of my holdings in bank stocks. Now, why did I do this? I'm not disappointed with the performance. I am fine with the REITs and the covered call ETFs and the bank stocks, but I divested them for different reasons. The REITs and the covered call ETFs, I divested both of those because it has become clearer to me as I do this longer, and I haven't always been a REIT investor or a covered call ETF investor. That's relatively new. I've been investing in other things for many years, but dividends that are paid out from REITs and covered call ETFs are taxed at a higher rate. Okay, unlike most of our dividend investments, which are considered, the dividends are considered qualified dividends. Those are taxed as capital gains. However, REITs and covered call ETFs are considered ordinary dividend income. They're not qualified dividend income like the others. They're ordinary dividend income, and they are taxed as ordinary income. They are taxed at a higher rate. Well, I decided, you know what? I like the flexibility of getting monthly dividend income from some of my REITs. I like the flexibility of getting monthly dividend income from my covered call ETFs. However, I do not like to pay the higher dividend income tax. So they're gone. Which ones were they? Yeah, I'll share them with you, and I have no problem with them. I think they're wonderful investments, and it kind of breaks my heart to do this, but Realty Income, and I think it's a wonderful investment. I love it. I think at some point everybody should own it. I just, the way the law is, the tax law is, I don't like to pay the higher taxable rate. And I also I divested American Tower, ticker symbol AMT, a wonderful company. I may decide to go back in. I do think that there is potential for a lot of growth in AMT. I think that at this time, I just don't want to pay the higher tax. The covered call ETFs, again, those are taxed at a higher rate. You know what? And why are they taxed at a higher rate rather than other ETFs? Well, covered call ETFs, those dividends are derived from two sources. Okay, one, their holdings in companies that pay dividends, like other dividend ETFs. However, in many cases, 75 to 80% of the dividend income comes from options selling that the management teams do. So those are taxed at a higher rate. So when you get your statement, to pay your tax on your dividend income, you're going to see two numbers. You're going to see the qualified dividend dollar amount and the ordinary dividend dollar amount. Well, the ordinary dividend amount is going to be a higher percentage. You're going to pay that at a higher rate. And those two, I'll just tell you, those were JEPI and JEPQ. And they're wonderful. Again, wonderful ETFs. I just, at this point, don't want to pay. Now, I love the flexibility of the monthly income. Just didn't want to pay the higher tax. So, bank stocks, we have seen a little bit of a shakeup in the banking industry recently with some of the bank failures with Silicon Valley Bank and Republic First Bank, I believe it was. So you know what? I got to tell you, I actually had one mid-sized bank and I divested it, and I had two very large ones. And I think that they're fine. But I just decided I wanted to step back from the my banking investments and reallocate my hard-earned, scarce investment dollars elsewhere. Which ones were the JP Morgan Chase, ticker symbol JPM, and Bank of America, ticker symbol BAC. So good companies. I may decide to go back in. I really like Bank of America's price. I also like the strength of JP Morgan Chase. But again, at this time, I just wanted to step back. So that's what I did. So that was several thousands of dollars that I took out. And I decided, well, I can do a couple things. I can put some into cash, which I did. And I can also reallocate it into some new holdings. So which holdings did I decide to go to? Well, here they are. And these were actually ones that I've been thinking about for a long time. And I also increased holdings in some existing stock. Let me just tell you, I went ahead and I added to my holdings in Microsoft and in Visa. I like Microsoft. I like Visa. These, to me, are great companies. Microsoft is a marquee technology company. I don't have it listed here. I'm just kind of talking off the cuff. And they're growing. They are growing in artificial intelligence. They're also going to be looking to grow in other areas. And who doesn't have Microsoft software on their computer? I see Microsoft exploding over the next 5 years. So anyway, that's why I increased my holdings in that. Visa is a cash cow. It's the largest, most widely used payment technology, and that's what it is. It's more than just a credit company. It's got a payment technology network out there that people use when they charge their credit card. And every time somebody charges a Visa card, as a dividend investor, you're making money. So anyway, I increased those. So, all right. Anyway, I've talked a lot about those holdings in previous videos. You can go back and look. So what is new? Well, Broadcom is new. Broadcom is a very successful large semiconductor company based out of San Jose. I like it. I've been thinking about Broadcom for a long time. I bought several shares. Broadcom is not a cheap company. The stock trades for over $631 a share, but the PE ratio is only 15. So compared to the S&P 500, which is, I believe, over 22 last time I checked, it's a good buy. The dividend yield is 2.92%. So what is that in terms of dollars and cents? Well, for every share, you're going to get an $18.40 annualized dividend payment. It pays quarterly. The market cap is $262 billion. It's not a small company. Now, the dividend yield, as I said, is 2.92%, but that 5-year CAGR, that dividend growth rate, is over 25.7%. It's impressive. They've been growing that dividend for 11 consecutive years. And so they've got a track record of increasing the annual dividend. So I'm in. The payout ratio is good. It's a safe dividend. Payout ratio is 43.9%. That dividend is good as gold. It's not going anywhere. Next one, Costco. Well, you know what? If you haven't been in a Costco, you need to get into a Costco. Most of us have been. I'm a member, like a lot of people. It's the big retail membership warehouse company. They're based out of Washington State. They're everywhere across the country, and they're around the world. They're based out of, as I said, they're based out of Washington State. It's not cheap. It's $504 a share. And I was debating on whether to go in this because I think it's a little bit pricey. The PE ratio is high. It's over 34. I was like, well, but I just think that there is just so much more room for Costco to continue to grow. So I bought several shares. I'm in. The market cap is 222 billion. It's got a rather modest dividend yield of 0.81%, which is about $4 a share. But the CAGR is nice. It's over 12.5%. So that meets the 10% hurdle that we've talked about. The hurdle being the yield and the CAGR. And so that's it. You're basically over 13% there. I like the dividend growth duration of 18 years. They've been increasing that dividend for 18 consecutive years. It's a safe dividend. The payout ratio is only 26%. So that's why I'm in. I think it's a good place to put your investment. Next one is CVS. So that's the drugstore pharmacy chain, and they're based in Rhode Island. I got to say something about CVS. They've been getting beat up in the market the last few weeks, but I think it's a good investment. They're trading for about $68. The PE ratio is under 8. I think it's worth more. It's got a decent dividend yield of 3.5%, which comes to about $2.42 a share. The CAGR is only 2.92%, so does it meet the hurdle? Not quite. However, I do think that this is an underpriced investment. Me anyway. That's my opinion, and I'm going with it. But I'm going to watch it closely. It is a market cap of 88 billion, and it's a safe dividend. It's the payout ratio is about 26%. So if your dividend's going to be safe with CVS. So now the next one is Lowe's. Well, Lowe's is a big home improvement retailer. They're based out of North Carolina. I got to tell you, with regards to Lowe's, I was kind of going back and forth. Should I invest in Lowe's? Should I invest in Home Depot? Should I invest in both? Well, I ruled out investing in both. I'm going to do one or the other. Okay. Got scarce. I want to put my scarce investment dollar in the best investment I can. I think that would be duplicative, where I'd be duplicating my effort to go for both. So I went with Lowe's, and I'm a customer of both. I think that Lowe's is probably get a little bit better bang for my buck. It's a little bit cheaper for me, and I went with it. Price is around $203 a share. The PE ratio is reasonable. It's a little bit under 15. The dividend yield is not bad. It's 2.07%. It comes to about $4.20 a share. But I got to tell you, I love that 5-year CAGR. That dividend growth rate is 20.69%. So that's what I like to see. I like to see a more modest but decent dividend yield in that 2 to 3% rate. But I typically like to see a CAGR of 7 to 8%. Well, this is over 20%. And then when I see that, I thought, wow, can they sustain that? So then I look, they've got a dividend growth streak of 59 years. So they are a dividend king. All right. This is a company that has a payout ratio of 29%. All right. Your dividend is safe with Lowe's. They're not going anywhere, folks. Their market cap's over $121 billion. This is a great investment. So I went with Lowe's. I bought several shares of Lowe's. So, next one, waste management. I got to tell you, one of the things I like to do is I've actually posted this on Twitter. I love it when I'm out driving around town and I see my investments out there. I love it when I drive past a CVS or I drive past a Lowe's or I drive past a Costco. You don't drive past a Broadcom because those are chips. Or you know what? I drive past a UPS truck. And also, I love it when I drive past a waste management truck or I see a waste management receptacle out there. Because hey, I own part of that. That makes me feel really good. So waste management, well, that's the big garbage collection, transportation, disposal, and recycling company. They're based out of Houston. And I've actually profiled them before in a previous video. And I decided to go all in. I like waste management. They're trading at 169. Their PE ratio is a little bit higher than the S&P 500. It's around 28. But you know what? It's higher because people buy into it because it's a safe investment. You see that with utilities. Those tend to have higher PE ratios. You get a lot of retirees that want a nice, safe investment to have stable dividend income and something that's going to hold its value. And that's what waste management is. Garbage is not going away. And you know what? This is an innovative company in recycling. And so I advise you to take a little closer look at them, do a little research on them. You'll be impressed. The dividend yield is it's about 1.65%. So it's a little bit on the lower side, but the 5-year CAGR is almost 8.8%. So you're over that 10% hurdle. They've been growing that dividend for just 3 years. Okay. I typically like to see 3 or 5 years. I like 5 years. I'll go with 3 years, but the payout ratio is safe. It's 47%. It's going to be a safe dividend. And I went all in. I bought several shares of waste management. So then, last but not least, UPS, United Parcel Service, that's the package delivery and transportation company. They're based out of Atlanta. I love UPS. And again, this is one where I was thinking FedEx, UPS, FedEx. Well, I looked closer at it. UPS is a much bigger company than FedEx. Okay, they're about 3 times the size market cap. Their price is a little cheaper, so I went with them. And you know what? I see more UPS trucks out there. See a lot of FedEx out there, fine company. But I went with UPS. They're trading about $170 a share. PE ratio is a little bit under 16. Okay, it's not bad. It's a good value. That dividend yield, 3.85%. That is a healthy dividend yield. But I got to tell you, I really, really like that 5-year CAGR. Okay, that compounded annual growth rate, that dividend growth rate, 12.5%. Now, let me go back. The yield, 3.85%, that's going to be about $6.48 a share. But that CAGR is just going to continue to grow. If they maintain a 12.5% or something near or around that, investors are going to be in good shape. They've been growing that dividend for 13 consecutive years. That is a good track record of dividend growth. Payout ratio, 51%. The dividend safe. Market cap, over $146 billion. So those are the new holdings that I have done. So let's take a look at the timing. So here are the holdings, and you see them by month. So what you see first and foremost, most of these pay March, June, September, and December, as do most dividend stocks and ETFs. So, you got Chevron, which is already in there, Broadcom, which is the new one. I'm looking at March. Visa, Waste Management, which is new. ConocoPhillips, which is one of my steady investments. I have some of the Schwab dividend ETF. UPS, okay, that's in there. That's the new one. Johnson & Johnson has been in there. It stays in there. Pfizer has been in there, stays in there. Kimbell Royalty Properties, okay, and I've talked about this one. This is a nice royalty property, oil and gas royalty company. It pays a beautiful dividend, and it's a cheap stock. That's in there. Lockheed Martin. Well, I like my defense stocks, Lockheed Martin, and you see Raytheon down below, and of course Microsoft. So those are the March, June, September, and December holdings that pay out in those months. So then what's left? Well, January, all I have is Altria Group, the tobacco company, which I think is a wonderful company, pays about $3.76 a share for each of my shares. And then, of course, in the February, May, August, and November, we've got AbbVie that pays $5.92, CVS, which is the new one that I talked about, and then Costco. And I already just talked about that. So that's the mix right now. So I am obviously looking to balance these out a little bit, because when I look at my my drip income, currently it's all dripping back into the investments. I'm basically dripping about 20% of my annual drip income in March, and then in June and September and December. So that's 80%. Okay, so the rest of those 20% of annual income is January, February, April, May, July, August, October, November. I am looking to add more passive income in January, February, April, May, July, August, October, and November. And I can do this one of two ways. I can increase my holdings in those January, February, April, May, July, August, October, November companies, or I can add more. And how can I do that? I could do a couple of things. I could go back into covered call ETFs, which I probably won't do, not at this point. I could do it in the future. I could go back into a couple of the monthly REITs, which I could do at some point, but probably not in the near future. More than likely, I'm going to increase my holdings in these existing companies, but I also look for other investment opportunities that pay out in these months. You know, when I was a beginning investor, I did not care about this stuff. But as you start to move through your investment time horizon, and you begin to get closer to the retirement time frame, you start to look at these more closely. But you know what? Even if you don't have that decent balance, this is quite impressively insightful. You can actually use this to budget your expenses. You say, well, listen, I'm going to be getting 20% of my annual income in March. That's going to be a big pay month. So I can pay my bills, and I'm going to basically plow some back into savings so that when April and May come around, I have plenty to pay those bills. And I might go ahead and reinvest. So anyway, that's how this looks now. What this is, it's the same thing. So it's basically the same thing. It's the holdings, but this is the dividend payment per share per month. So I won't go through each and every one of these. You can freeze the screen. You can go back and look at it. But in January, I am getting 94 cents per share of Altria, as well as in April and in July and in October. Okay, that is the vanilla kind of light mustard color right there in January. It's the only one. Yeah, it's very easy to tell. So you can tell by looking at that. Go to the purple down in March, third from the bottom. That's Lockheed Martin. I'm getting $12 a share per year. So every March, every June, every September, and every December, I'm going to be getting $3 per share. So that's what I'm getting there. Now, if you go up March, second from the top, that's Broadcom. That's the new one. Okay, that's where I'm going to be getting $18.40 a share. So that's $4.60 in March, and then in June, and then in September, and then in December. So you get the picture of how this is basically shaken out. So now, if I want to go and look, as I mentioned, at my passive income, right now it's passive drip income because it's all going back in. I'm getting almost 20% of that in March and in June and in September and in December. So again, I'm kind of light in January and February. I'm light in April and May. I'm light in July and August. And I'm light in October and November. Now, I got to tell you, my uh, passive drip income is pretty decent. It's significant. So I have more than enough if I were to retire soon to cover me for the year in those months of March, June, September, and December. But like all investors, we like more. More is preferred to less. Okay, we want to maximize our holdings and get more income. So again, I am looking to increase holdings in January. They'll pay out in January and February, April and May, July and August, October and November. That is the plan. So you've seen that, and I've discussed the observations already. Here it is. Most of that dividend income payout is in March, June, September, and December. My requirement is to build holdings that increase in those other months. You see them below. I already talked about them. So what are the options? Monthly dividend stocks and ETFs. I can do each and every one of those. I'm kind of set against going back into REITs. I'm kind of set against, at this point, going back into covered call ETFs. However, I'm not completely opposed to it. But here is my ask from you, my listeners. Give me your thoughts on this. If you have ideas on where we can go ahead and look at adding holdings that pay out in these months under the second bullet, let me know. You know what? And I'm looking at business development companies. All right, as a possibility. I've held them before. I may hold them again. I'm thinking about Main Street Capital and some of the others. So anyway, let me know. I would appreciate your feedback. And if you found this useful, please give us a like and subscribe to our channel and share this with a friend or a family member. Until our next video, you guys take care and God bless.